I thought we'd just start with gold, actually, because it's, first of all, something we write a lot about, a great deal, have done over the years, something we trade a lot, and it's at an interesting juncture once more. But the chart I actually want to come to the daily in a moment, but the chart I actually want to show you is the 5-minute chart. Just flick that up full size. Over on the left here, I've got the time and sales window. If you're wondering what that is basically the orders going through the system right now, on the bid and the ask, or between the bid and the ask, or below the bid and above the ask. I won't go through it in detail, but this is basically the order flow through for gold futures right now. What I actually wanted to show you was really several things about volume price analysis and also congestion opportunities, of which this is setting up to be an example. But in terms of the volume price analysis methodology, we had this nice rally. The trend monitor transitioned through to blue. We had this nice rally. We had some rising volume here, pushing the market higher. And then as we get to this candle, we get the first signal of weakness because we've got high volume and we've got a big wick to the upper body and a narrow spread candle in the body itself. And therefore, that is a first sign of selling pressure. It's not indicative that the market is necessarily going to roll over because, as we've said many, many times before, when you see these signals in VPA, it's very easy to get excited and think, oh, great, I'll go short. Occasionally, you do get V-shaped rallies. Occasionally, you do get V-shaped reversals. In other words, you get one candle like that and bang, goes to the downside. But generally speaking, that is not the case because the market is very much like an oil tanker. You know, if it has momentum, it takes time to slow. There's always a bit of an overrun, a follow through, if you will, before you get into those congestion phases, which you expect and anticipate once you start to see the signals, and you see the same in the downside. So basically, you see that sort of signal, and that's really just a heads up that this market, you know, we've had this rally. There's probably a lot of profit taking in there. It's not done yet, it carries on, but look at the volume falling away, it falls away, and then we start to go into really a confirmation of that weakness in terms of doji candles. We're starting to hit a level here, which is defined by the accumulation distribution indicator. So it's giving us a very strong clue of resistance building in this region. We've got pivots developing to the top here, as you can see. But the candle that really kind of gives it away, if you will, is this one here. It's a widespread up candle, but you look at the volume associated with it, which is this one here. Now, we're in the same session here. So from 1+1 onwards, here we are in the gold futures session pretty much. So we can compare volume through here against other volume to give us a benchmark. And whilst we normally do expect to see increased activity at the open, it always happens that way, same in index futures. What you're looking for is a comparative metric. You're looking for a benchmark. So when you look at that price action, you're looking for candles of a similar size and shape. And we've got one here, for example. And then you look at the volume associated with that one. So you look down here at the volume associated with it. And that's what you're doing the whole time. You're looking for comparative measures of this price action, this volume, this price action, this volume. So it's an indication that there is weakness, that the market is being pushed up on low volume. There is insufficient volume to drive the market to that sort of level. And it's really just confirming what you're seeing here and here, that this is a congestion phase building with a potential reversal building. What we're also seeing now is classic VPA price action in a congestion. In other words, the volume down here has died away to practically nothing. The spreads here are narrowing. We had a decent move here on decent volume, but then it's fallen away again. Now we've got very low volume indeed through this region here. So we know for a fact we're in congestion. The price spreads are narrowing. It's classic congestion phase price action. And all that's required now is for us to be patient, because what we've also had in this move is we've driven up through these regions, which at the time, remember, would have been acting as we broke away from the volume point of control, these would have been acting as resistance. So we drove through that one pretty healthily. We then had the weakness. We then had a further drive higher, but we had really some more weakness, because with that amount of volume into that sort of spread of price action, you would have expected to see a much wider candle, probably something like this, if not more. And we've actually got pretty narrow spreads. So again, this is really just confirming that weakness that's now coming into the market. Nevertheless, this is acting as a platform of support once we've breached it as resistance. And now we're developing resistance at this level, and we've got this platform in underneath here. So in terms of a congestion opportunity, in other words, if you're going to trade this as a breakaway opportunity, what you're looking at now is it's a pretty narrow range. This is from 85 to 91, so it's $4 or $5 an ounce in here. It's healthy in terms of profit if you're trading $4 or $5 on a take, but in terms of congestion phase, it's pretty narrow. And what a congestion phase does for you is really define very clearly, as I said the other day, very clear where your potential entry might be and also where your potential stop loss might be. So if you're looking at this as an upside move, if you're waiting for this market to break to the upside, it's not what the trend monitor is saying, but if you were, you'd obviously be looking at this ceiling here and move through that ceiling on decent volume through 92, 93 maybe. And then once you've had that confirmation on good volume that it is a true breakaway and not a fake out, then you have the opportunity to trade that to the upside, with the benefit of having this great solid platform of support in below you. And that is one of the beauties of trading congestion, and obviously vice versa. If it breaks to the downside, if it broke through certainly this region, the difference between the upside break and the downside break is very clear. If you take these two levels here as your channel, if you will, this level at just above 86 and this level here at 91, the issue for a breakthrough 91 and beyond, and obviously we would look at, and you can just see the volume point of control has literally hopped up the screen there as I'm talking, because the volume is now building in this region. So the volume here is the highest congestion we've got on the chart. But if you're looking at this as an upside break, and obviously you'd move up to different time frames, in terms of what's in the way, certainly there's nothing in the way to the upside, but if you break to the downside, you're immediately going to run into this, followed by this. So from a trading perspective, if it was a break to the downside, it would have to be on very good volume, and you'd also have to be on the appreciation that you've got some pretty strong potential levels of support coming into play, which may well cause that particular trade to stutter at that point, and certainly at this point. And actually, you can consider these as a cluster of two. And those are the principles of breakaway trading. The advantage of congestion trading is that it sets all the levels out for you very clearly, almost with a slide rule. So you know your ceiling of resistance, you generally know your floor of support, and then it's very clear where you would put your stop loss. If this breaks to the upside, then you'd put it below here somewhere, maybe below there if your risk and money management is good for that. If it breaks the downside, you'd put it above this level, because for the market to reverse and break through this is going to take a huge amount of effort. So you've got an actual ton of natural price-based protection in place. And that is not true when you're trading a trend. If you're jumping on the trend here, you may well have levels up and down the chart, but you don't have that density of protection that you do when you have a congestion phase or a breakaway from a congestion phase. And the only downside of trading out of a range like this is we've just got to be patient. Now this may be here, it may sit here for the next few hours, it may sit here into probably Friday, if be very light trading if the market's open at all, often on into Monday. But at some point the market will break away. Markets trade longer in congestion phases than they do in trend phases. It's just a question of being patient and waiting for that congestion to break. And when it breaks, the one thing that confirms it is volume. And that's why breakaway trading gets a bad press, generally speaking, and why volume traders are very good at it, because they understand that volume confirms the breakaway, and therefore they tend not to get caught with fake outs, which are reasonably common. But if you use volume price analysis, you won't. So I just wanted to highlight it here. Over on the time and sales, just checking over on the time and sales, this gives you a straight clue as to the sort of trading participation right now. You can see the numbers down here, they're all single figures. And what you're looking at as an order flow trader with the time and sales window or the depth of market order flow, what you're looking for constantly is not the ones and twos, is what you're looking for is the blocks. I've got this set to a block. I can't remember what the parameter is on this particular market, but it'll have a block setting and it will highlight major blocks. So what you're looking for is, a rule of thumb is certainly double figures, anything in the 10s, 20s, 30s, that sort of nature, because that is the sort of block size that is really going to shift the market. Obviously, when you've got ones and twos going through like this, then it's going to tend to not have a great momentum to it, as you can see here. What you'll also see on this window is when momentum increases, the speed of order flow also increases. It's a little bit like the tick speedometer on the tick charts, which I know some of you have and are familiar with, where you're actually seeing the market speed up and slow down. Well, it's the same in terms of time and sales and order flow. When the market starts to move fast, this will start to speed up dramatically, and as the orders pile in. At the moment, you can see it's pretty sluggish. You know, there's quite big gaps here, 3-4 seconds between the orders coming in, and they're all onesie twosies. So what you're constantly looking for is blocks of trades which are going to move the market, and then you want to see how much they move the market by. And the opposite is also true. If they don't move the market, then that is a key signal that the market is weak. In other words, volume is going in, and it's obviously all tied into the volume down here. So we use it in combination. We're going to be doing a lot more on this once we get TradeStation up and running. So we will be coming back to this and doing it on a regular basis. But I just wanted to highlight that chart because it's just a fascinating chart, the 5-minute chart there for gold. Lots of trading lessons in there. In terms of the other time frames, you can see we've got the volume point of control. That's the 3-minute. Similar sort of picture. We've got the volume point of control sat in the middle. We've got a very strong ceiling of resistance sat here. We've got a platform of support below. And you know, given we're on a 3-day holiday in the US and we're running, you know, later into the session now, the probability is that the markets will move into congestion phase. A lot of traders will be packing up early anyway on a day like this, and hence that's another reason that the markets are pretty thin and volume is low. Let's go and have a look at the indices. Let's go. Let's have a look at all three. There we go. The indices, as Anna pointed out, are, let's tie that up a bit. There we are. The indices are at a very interesting juncture. Let me just reload that. And they're really defined, if you will. That differentiation is really, if we look at the YM on the daily, this was the reaction we had on the daily, the big plunge. And since then, we've been trading within the spread of that candle. And it hasn't moved. And whilst the NQ, pop that up full size, has continued higher, this is the equivalent day on the NQ. And yet it has broken out into new high ground and continues to do so. And the two others, whilst the ES, let's move that up there, we are out the way a little bit, there we go. The ES is very similar to the YM. This is the day of the plunge and have been trading in that range ever since. So the NQ is trading really in isolation, it's out on its own, and the other two, the ES and the YM, are really very sluggish, particularly the YM. Which does not show any signs, just reload that, there we go, which does not show any strong signs of bullish sentiment. Indeed, the trend monitor is signaling bearish sentiment. Ever since we had the reversal from up here, we've had some flip-flopping around of colors. The attempt to rally, then we're back into bearish, and we're remaining bearish for the time being. So, you know, that is not a picture of strength right now. It may well break out and it may well follow the NQ higher, but the NQ is out alone. It is unusual. I would say it's anomalous because under normal circumstances, you would expect these markets to correlate relatively closely, which they do most of the time, both from a price perspective and intraday. but at the moment they are not. And that is it's an interesting picture, and it's a question of how long the NQ will continue in that direction before the sentiment that continues to weigh on the YM and the ES actually pulls it back, because it's certainly not following through in either of them. And as I say, until we break outside of this range on the daily candle for either the ES or the YM, this is the candle here on the NQ, already we're broken out well away from there, moving up into a low volume region. Volume's fine on there, but until we see that price action develop, then it is anomalous to say the least. I've got the time and sales over here as well, and this one is linked to the NQ. So that's what you're seeing there are the figures for the NQ. And again, as you can see, pretty low numbers, no big blocks going through there. It's as you see it, once the price action starts to move, you'll see the speed up dramatically. You can see it there, that little pullback. You'll start to see the price action move, prices coming through between the spreads, below the bid, the ask, what have you. That's what the different colors are. But that's what you see. You see the speeding up and slowing down, and it's very similar to the tick chart activity, where you get a sense of momentum, which you don't see on a time-based chart. Let me just pause there for a moment, if I may. Just find see if there are any questions. Let's get the chat box has gone over the other screen. Oh, it's tiny now. There we are. That's it. Nope, I think we're okay. Can I pass back to you, darling?
Yeah, sure.
I'm just going to pass back to Anna at that point.